Oh, it's a mixed bag. This past quarter, we certainly saw some good same-store sales numbers coming out of the fast food brands. There were a number of especially strong performers within casual dining. So clearly, I think consumers, they want to get back out. They want to dine. They've got a little bit more take-home pay, and I think they're enjoying it right now.
Bob, I'm really confused. We had you on, I think it was 6 months ago. Restaurants were dying. It was awful. Nobody was going out. They were staying home. They were watching Netflix and ordering pizza. What happened?
Well, the key thing, I think, for same-store sales growth has really come from convenience. It's got to be more convenient. And I think casual dining is increasingly tapping into finding ways to make it more convenient with third-party delivery, more off-premise, more carry-out programs. Those things are really good catalysts, not only for the casual dining, but also for fast food. So it's got to be more convenient for consumers.
Are the chains winning, or are independents holding their own?
It's a great question, and if you look at the recent July data, it certainly begs that question. The government data suggested it was literally one of the strongest months in years for the industry, yet the same-store sales numbers coming out of both KNAPP-TRACK and Black Box, the major indices, were abysmal, especially compared to last year. So that suggests to me that those sales that are being captured by the government data are finding a lot more ways than just the same-store sales data. In other words, there's more numbers going into that versus the year-over-year sale. There's sales growth year-over-year from new units. There's menu pricing. There's sales that are going to those smaller mom and pops that aren't captured by the major indices.
Bob, does the data capture whether people are actually going into restaurants to eat versus having stuff delivered to their home? I mean, you mentioned convenience before. We have seen a proliferation of delivery service startups. And I would imagine for restaurants, they're not going to make as much money when people are delivering in and ordering in versus when they're coming in and they're buying water and they're buying alcohol and being upsold everything.
That's a great point. And those incremental sales, while they help overall sales, the delivery sales, for these brands, the profitability on those numbers aren't nearly as good. And I think, a great case in point was, we saw Applebee's put up very, very strong numbers recently, as a chain. However, we also have seen some real weakness across their franchise base because the franchisees that are generating those higher sales aren't necessarily making as much money profit-wise on those sales as the franchisor.
You got any top picks, Bob?
We're still leaning towards both McDonald's as well as Jack in the Box. I think the product differentiation from Jack in the Box is going to make them an outlier and show good performance. And I think McDonald's, the marketing muscle they bring, the remodel of their restaurants, and the new product innovation that's coming, I think will continue to drive that stock higher.